Hey everyone, welcome back. We're going to examine last week's put sales where we sold puts on companies that had high implied volatility and had earnings coming up. And then this week we'll look at see what's coming up the following week. So with that, let's jump in. As always, this is not financial advice. All right, so here's what we did last week. Now, last week was a pretty quiet week. And then on Friday, everything came crumbling down. So what we did is throughout the middle of the week, we had entered some of these positions. I'd entered all of this, what you see here, Wells Fargo, Schwab, American Express, Freeport, General Electric, and Boston Scientific. I'd also entered a few others, not just this, but there was a few others that I entered. And as the week went on, call it Tuesday, probably about Wednesday, there were a couple of positions that were pretty much 95% profitable, and so I went ahead and took those. Well, on Friday, everything was actually very profitable. Wells Fargo, Schwab, American Express, all of these were way out of the money, and I was close to getting the full value that I had sold them for. These are the positions, and then these are what the prices that I got. Now, multiply this by 100. It's $25 credit, $18 credit, and so on, but this is just per share. So I did a $79.76 on this one, $92.90. Each one of these is $200, or this one's $300 apart, $200 apart, $500 apart, and so on and so forth. So this is the price that I received for taking a $300 risk. That's not that bad. It's not quite 10%, maybe about 8%. This would have been $20 on a $200 investment. Again, not bad, 9% here. A little over 10% on American Express, and so on and so forth. FCX, $100 investment, because of what happened with FCX the week or two prior. Premiums are very juicy on FCX, and so I went ahead and sold more puts. So what you see here is the positions that I had entered, and then I closed them out. So this $110 down here, this is if I were to do one contract each, $110, and all of this, if you were to add that up, is a $1,900 investment. So $110 on a $1,900 investment, assuming you only did one contract, that's a 5.7% return. Some of these, it doesn't add up quite to 110 because I had to close them out early. Like when the market started cratering on Friday, for example, Wells Fargo, I didn't get 25 cents. I actually got 11 because it was 81. So I was like 2 cents left to go. And I was just going to let it expire worthless and not eat the commission costs and then get the two or three extra dollars. When it cratered, it went all the way down to 79. Actually went below 79. And then came back up. And so when it came back up, it was like 79.25. I just entered in a sell order. When those positions profitable, I just closed it. Schwab actually expired above 92, but I went ahead and closed this one. I think I closed this one for 5 cents. American Express, I did take a little bit of a loss on this one because it cratered. It was 326, 327 during the middle of the day. And then all of a sudden it just went all the way down to 319, closed it out. When it went below 320, I went ahead and closed it. All of these, once they get to a certain spot, once they hit their short strike, that's the time to close it. And I'm glad I did because American Express then continued to tank, and I think it ended up closing the day out at like 317, 316. So that would have been almost a $400 loss for a $56 or for $56 in premium, and it just definitely wasn't worth it. So once it hit that I think it was 319.55, somewhere along in there, closed it out. Took a $22 hit, but all in, all these positions, after it was all said and done, made $110, assuming one contract each, and that was a $1,900 investment for all of that. So again, 5.7, not too bad. All right, so what's coming up this week? Now, there's a lot of stocks out there with high implied volatility because of what happened on Friday. But these are the ones that I scanned and removed if earnings were this week or 3 weeks and beyond. So this is what made my list. And I'll probably enter Netflix. Netflix, $11.55 is the recommended strike price. I'll look at it Monday morning. First of all, if the market continues to crater, I may not enter any of these. But if it looks like it's settled overnight, and when the futures market opens here in just a little bit, if the market settles, I'll probably be looking at the expected move. Remember, we talked about that before. If you look at implied volatility, go 1 to 2 times the expected move. As of Friday, this was the expected move. So we'll figure that out Monday morning. I will post my trades on the YouTube comments Monday night. Capital One, I probably won't do. And the reason that is because Capital One, a lot of the bank stocks actually report this week. So if I'm trading Capital One and banks take a hit this week, then Capital One will take a hit. It'll fall in sympathy. So I probably won't do Capital One. Boston Scientific, I did that last week. I'll probably do it again this week because it also cratered. It was up at $97, almost $98, and fell down to $95.41. So I will take even a lower position than I did this week. Tesla. Now, I'm not sure about Tesla if I'm going to do this one or not. It did crater. It was $450 last week. It's now $413 because of what happened on Friday. The strike, it's recommended at this point, is $375. I may go a little bit lower than that if I do Tesla. Freeport, yep, probably going to do that one again. NextEra, yes. And then I won't go through all of these. But here's what we're looking for. Okay, this is Netflix. So look at the implied volatility. So much higher than historical. That means premiums are going to be super juicy. You can tell this is this earnings, the last earnings. Let's take a look at Tesla. Same thing. Yep, high implied volatility, way over historical. So that means I can probably do some trading on this one. All right, here's Tesla. You can see we got earnings coming up. This is the view that I'm looking at. So it's recommending 375, which puts it right at its 50-day moving average. I don't know if that's far enough. I may go down below the 50-day moving average on Tesla. I've got some other signals here, and this is why I went ahead and shorted it. I actually wrote this script to tell me when an ideal time to short it is, and that's based on overbought conditions. Still testing this one out. I will share this with you at some point in the future. It is my own indicator, and you can see when it tells me to buy. And it worked temporarily on this one, and then it worked, and then I got some confirmed sales, and then it dropped. So this is why I shorted it this week. It was just at a really overbought position. All right, here's Amazon. Look at that implied volatility. Again, because of what happened on Friday, just went through the roof. So it is recommending a $200 strike. We will see. We'll see what that does Monday morning. But look at the ROIs. This is based on naked puts. We will be protecting this with a put below this strike. So we will not be taking unlimited risk, or not unlimited risk, but a significant amount of risk. We're going to cap our risk, and we'll buy a strike. And this one, in this case for Netflix, we might buy a strike 5 points below. Same thing with Amazon. FCX, I might go 2 points below and give up a little bit of this $27 premium. But my ROIs are going to be even better than this. So all that said, this is what I'm trading this week. Let's jump into one more thing called Volatility Crush. I'm going to introduce this to you. I'm not going to tell you which ones I'm going to do this on, but there will be some stocks I do this on this week that have earnings. Put sales, we're trading volatility, and we're in and we're out before earnings. Volatility Crush is playing the earnings itself. And the way it works, I'm going to introduce this, and then we'll talk about it a little bit more next week, and we'll see how it worked out. But let's say I was doing this on Netflix. My position might look like this. All right, the stock is maybe selling for somewhere around in here. What did you say? It was like $1,200. I'm going to, if I play this, it won't be Netflix, but it'll be another stock this week, but we're just going to use Netflix as an example. What I'm going to do is I'm going to go down here, and I'm going to sell a 20 delta and a 20 delta for this coming Friday. So this will be the front month. They call it front month, but it's the front expiration. And I'm going to get this one, and I'm going to get this one. These are going to be very expensive because of it being the week of earnings. But to hedge it, I'm going to buy the back month. And that is the following week. But I'm going to still say buy the same strike. So let's say this strike was $11.50 and this one's $12.50. I'm going to sell the $11.50 and the $12.50, but the back month, the following week, I'm going to buy the $11.50 and buy the $12.50. The idea is these guys are so expensive. This is really hard to diagram out, actually, in a profit diagram. But these might be selling, I'm just going to pick a number. This might sell for $8 each. This one might sell for $9. I'm only going to be out whatever the debit that I paid, because I'm selling these two at 16, buying these two for 18, then that would be a $2 spread. So that's all I would be out. It's $200 per contract. The goal would be is to have this collapse instantly, because let's say this was on Wednesday and you've got till Friday, you've got 2 days left. They're going to collapse to nothing, assuming that the stock stays in this range. As long as it stays within this range, these guys collapse to nothing. This is 16. This still has some time left, another week. So this will fall as well, but it might only fall to $4. And this one might only fall to $4. I'm using this as an example. I will show this and I'll show you exactly what the position and how I played it. This would sell for $8, so this still has some time. I'm going to lose $10 here, but I'm going to make $16 here. So that would be a very profitable trade. The back months for sure are going to lose money, but they're not going to lose as much as the front month. The front month is going to lose everything, and that's what you're capitalizing on. So that was just a tiny little introduction. I will actually show you some real positions. I'll probably show you in Thinkorswim how to actually execute the trade. So be watching out for that next week. And with that, thank you very much. If you enjoy this, please send me some comments in the YouTube and let me know. And with that, happy trading.